You've been working 60-hour weeks. You've invested your savings. You've told yourself this is the asset that's going to change everything. But what if I told you that most of what entrepreneurs call assets are quietly bleeding them dry? Today, we're breaking down 7 assets that feel like wealth-building moves, but are actually wealth traps. And I promise you, at least 3 of these are things you're doing right now. Stay until the end, because number 7 is the one nobody talks about, and it might be the most expensive mistake of your life. Welcome back. If you're new here, this channel is about cutting through the financial noise. No fluff, no guru hype, just real economic principles that help entrepreneurs build actual wealth. Hit subscribe if you want more content like this. Now let's get into it. Asset number 1, the high-end business vehicle. Every entrepreneur has heard this one. You can write it off. So they go out and lease a $90,000 SUV. They slap a logo on the door, park it outside the office, and call it a business asset. Here's the brutal truth. A car is not an asset. It's a depreciating liability wearing a business suit. The moment you drive it off the lot, it loses 15 to 20% of its value. You're paying insurance, maintenance, fuel, and interest every single month. And yes, there are tax deductions, but you don't deduct the full purchase price in most cases, and you're still paying more than you're saving. The rich don't buy expensive cars to look wealthy. They buy cheap cars while becoming wealthy. A luxury car is a statement of ego, not a strategy for equity. The rule, if it parks in your driveway and loses value, it's a liability, period. Asset number 2, their own business as their only asset. This one stinks, so stay with me. Your business can be an asset, but only if it can run without you. If the moment you step away, revenue stops, you don't own an asset. You've bought yourself a very stressful job. Most entrepreneurs pour every dollar back into the business. No stocks, no real estate, no diversification, just the business. And statistically, 65% of small businesses don't survive past 10 years. Think about what that means. Your entire net worth, gone. Wealthy entrepreneurs treat their business as a tool to generate income, and then they use that income to buy real diversified assets. The business funds the portfolio. The portfolio builds the freedom. The rule, if your wealth lives and dies with one business, you're not building an empire. You're building a single point of failure. Asset number 3, commercial real estate purchased too early. Real estate can build wealth, but commercial property bought by an early-stage entrepreneur almost always does the opposite. Here's the scenario. Revenue is solid for a year or 2, so you buy an office building. You're paying a mortgage, property taxes, maintenance, and insurance. Then, a recession hits. A contract falls through. Remote work changes your needs, and now you're trapped in a fixed cost that's eating your cash flow alive. Owning your office before your business model is truly proven is one of the most common wealth killers in entrepreneurship. Commercial real estate is an asset for investors with capital reserves, not for businesses still in growth mode. The rule, lease until your cash flow is bulletproof. Then consider ownership. Asset number 4, the $10,000 mastermind or certification. Now, before you come for me in the comments, education can be one of the best investments you make. Genuine skill building, absolutely worth it. But here's what's actually happening in the entrepreneur space. People are spending $5,000, $10,000, even $25,000 on masterminds, coaching programs, and premium certifications that produce zero measurable return. You buy the course, you feel productive, you get a certificate, and then nothing changes. Because information without implementation is just expensive entertainment. Knowledge only becomes an asset when it directly generates more revenue than it costs. If you can't map a clear line from that 10K course to 10K plus in new revenue, it wasn't an asset. It was a comfort purchase disguised as a business decision. The rule, before buying any program, ask, what is the specific measurable outcome? If they can't answer that, walk away.
Asset number 5, excess inventory and equipment. This one is massive in product-based businesses and manufacturing. An entrepreneur gets a bulk discount, so they buy 10x more inventory than they need. Or they buy top-of-the-line equipment because one day the volume will justify it. On paper, it shows up as an asset on the balance sheet. In reality, it's cash tied up in stuff that isn't generating a return today. Inventory sitting in a warehouse is cash that can't be invested. Equipment that's 30% utilized is leaking value through depreciation. And if market demand shifts, that inventory becomes worthless. Amazon didn't build the world's greatest logistics empire by stockpiling product. They mastered just-in-time inventory and ruthlessly protected their cash flow. The rule: capital efficiency beats asset accumulation every time. Only buy what you can turn into revenue this quarter. Asset number 6, the primary home, especially the oversized one. This might be the most controversial thing I say today, but it's backed by hard economics. Your personal home is not an investment. Robert Kiyosaki said it. Real data confirms it. Your personal home takes money out of your pocket every month. Mortgage, taxes, utilities, maintenance, HOA, it doesn't put money in. Now, yes, homes appreciate over time, but when you factor in all carrying costs over 30 years, the real inflation-adjusted return on a primary home is remarkably thin. Meanwhile, that same capital invested in a diversified portfolio or income-generating property with a tenant covering the mortgage builds actual compounding wealth. Entrepreneurs often upgrade their home every time revenue spikes. Bigger house, bigger mortgage, bigger lifestyle costs, and less free capital to invest. It's the wealth trap hiding behind the American dream. The rule: your home is where you live. Rental property is where you invest. Know the difference. Asset number 7, a personal brand with no monetization engine behind it. This is the one nobody talks about, and it might be the most expensive mistake of the 2020s. Entrepreneurs are spending years and thousands of dollars building Instagram followings, LinkedIn audiences, podcast shows, and YouTube channels. They call it building an asset, and it can be, but almost always it isn't. Here's why. A following is not revenue. Attention is not cash flow. If your content doesn't connect to a clear, scalable offer, a product, a service, a course, or a community, then you have built an audience that you entertain for free. Social media platforms own your audience, not you. Algorithm changes can cut your reach overnight. Without a direct monetization path and an owned channel like an email list, your brand asset is built on rented land. The rule: content is the top of the funnel. It only becomes an asset when the funnel has a profitable bottom. Here's the bottom line. Wealth isn't built by collecting assets. It's built by collecting the right assets, ones that generate cash flow, appreciate in value, and don't depend entirely on your time. The entrepreneurs who get truly rich aren't the ones with the biggest offices or the shiniest cars. They're the ones who ask the hardest question every time they spent money. Does this put money in my pocket or take it out? If this hit home, share it with one entrepreneur who needs to hear it. Drop in the comments which of these you've fallen for. I'm willing to bet it's at least one. Like, subscribe, and I'll see you in the next one.